Good morning. Thank you all for participating in this inaugural public hearing of the CSBS Emerging Payments Task Force. My name is David Cotney. I'm the Massachusetts Commissioner of Banks. I also serve as chairman of the CSBS Emerging Payments Task Force. Joining me today are my fellow members of the Emerging Payments Task Force. Starting to my far right, Drew Breakspear, Commissioner, the Florida Office of Financial Regulation; Kevin Hagler, Commissioner, Georgia Department of Banking and Finance; Manny Flores, Acting Secretary of the Illinois Department of Financial and Professional Regulation, and our host today at our hearing here in Chicago; Dana Syracuse, Associate General Counsel at the New York State Department of Financial Services; Greg Gonzalez, Commissioner at the Tennessee Department of Financial Institutions; Charles Cooper, Commissioner at the Texas Department of Banking; Ed Leary, Commissioner at the Utah Department of Financial Institutions; and Scott Jarvis, Director at the Washington Department of Financial Institutions. And I also want to acknowledge my fellow state regulators who are in attendance here today. First, let me start with a bit of background on the Conference of State Bank Supervisors, or CSBS. CSBS is the nationwide organization of banking regulators from the 50 states and U.S. territories. For more than 100 years, CSBS has given state supervisors a national forum to coordinate supervision and develop financial policy. Put simply, CSBS is the D.C. field office of state financial regulators. State regulatory agencies charter and regulate insured depository institutions such as banks and credit unions. But most states also have jurisdiction over non-bank financial service providers as well. This includes mortgage lenders and brokers, money transmitters, payday lenders, check cashers, and finance companies. Through CSBS, state regulators coordinate supervision of these entities, discuss emerging trends in our states, and work together to address changes or developments in the financial services industry. One of the developments that caught our attention last year was the change we saw taking place in the payments systems and how this evolution was impacting banks and non-banks, the role of state supervision, consumer behavior, and financial market stability. To better address these changes, state regulators, through CSBS, formed this Emerging Payments Task Force. Our objective as a task force is to study changes in payment systems to determine the potential impact on consumers, state law, and banks and non-bank entities chartered or licensed by state regulators. We have been charged with taking a comprehensive approach to studying the changing payment systems, including virtual currencies, but I want to stress that this task force is charged with evaluating and studying payments developments beyond virtual currency. Recognizing the varied perspectives and breadth of the issues we've been asked to study, the task force believes it is critical to engage external stakeholders on these important issues. As such, this hearing is a first step to getting input from industry participants and subject matter experts to understand how new entrants and technologies affect the stability of payment systems and the broader financial marketplace. And just on a side note, while the focus of this hearing is on industry developments, our task force will schedule a hearing later this year to focus on the impact on consumers and consumer protection. As state regulators, we have many supervisory tools at our disposal, but we welcome the opportunity to explore how to adapt the existing supervisory framework to address emerging trends. Many of the changes we've seen over the past few years, such as mobile payments, peer-to-peer, and virtual currency, just to name a few, have been driven by demand from consumers, financial industry, and businesses for a better payment system, one that is more secure, more real-time, and less costly. Ultimately, we are seeking the best possible supervisory structure to encourage innovation while still maintaining safety and soundness, public confidence, and consumer protection. And this hearing is a critical component of our understanding of the state of play, and we very much appreciate everyone's attendance and participation in this inaugural public hearing on emerging payments. So before I introduce the first panel, a few housekeeping announcements. First, please silence all cell phones. This hearing is being streamed live via a webcast, and a recording will be made available in the coming days. We have 3 panels today, each scheduled to last 1 hour, and will consist of brief opening statements, followed by question and answer. And I want to thank panelists in advance for keeping their opening remarks brief. Following each panel, there will be a short break to give us a chance to transition, and after the 3rd panel, time permitting, we will open up the session for comments from other attendees. The first panel will focus on legacy payment systems such as check, ACH, and debit and credit cards. Second will feature a discussion on retail payments innovations such as mobile payments. And our 3rd and final panel will be on virtual currencies. And we are scheduled to adjourn at 1:30 Central Time. And finally, I just want to take a moment to thank CSBS staff for all of their hard work in putting this public hearing together. So now it is my pleasure to introduce our first panel focusing on legacy payments systems. Our panelists this morning are Chris Daniel, partner with Paul Hastings, LLP, Jane Larimer, Executive Vice President of NACHA, and Bob Steen, Chief Executive Officer of Bridge Community Bank. And again, thank you for keeping your opening remarks brief this morning. This will allow us for some good dialogue with the task force. So, Mr. Daniel, if you could please begin.
Thank you, Commissioner Cotney, and thanks to the CSBS Emerging Payments Task Force for holding this important hearing, and thanks to all of you in the room and on the web who are attending. In my very brief presentation this morning, I'm going to try to accomplish 2 things. I want to provide a larger strategic perspective on why there is such an opportunity for emerging payments and alternative or virtual currencies. I also want to educate briefly everyone on the legacy payment systems in the United States. My overview will cover a history of currency in the United States, the M1 money supply, modern payment systems, shared attributes of successful payment systems, examples, and currency and technology as a closing remark. I want to start with a quote, only because I think that oftentimes in the financial services sector, we think so much of what we've done and what we have is settled. And the truth of the matter historically is it's been anything but settled. This comes from a book entitled The Money Men, Capitalism, Democracy, and the 100 Years War Over the American Dollar. For the first 5 generations of America's independent history, from 1776 till the eve of World War I, a single question has vexed American politics and the American economy more persistently than any other. Political careers were made and broken on this question. Political parties rose and fell. Great wealth rewarded those who answered it correctly. Bankruptcy claimed those who got it wrong. No question touched more livelihoods and more lives more consistently, more intimately, more portentously. The question was the money question. In simplest form, it asked, what constitutes money in the United States? As we can see from the next slide, we've had numerous types of currencies in the United States throughout our history. We had colonial currency. Actually, the first currency in our colonies was the Spanish silver dollar. We've had colonial currencies. We've had state bank issued notes during the Wildcat period. We've had Civil War greenbacks. We've had bimetallism, gold, silver, the Gold Standard Act. We had the Bretton Woods system, which was wonderful from a gold standard. We came off Bretton Woods in 1971. So the idea of what currency actually is in the United States has been far from a settled question. Because I've always liked show and tell, here's an 1862 greenback that was issued in the Civil War to finance the Union's efforts in the Civil War. So you can tell from both the opening quote and from the continuum or timeline on the screen, currency and monetary value, again, has not always been settled. And I think we find ourselves at this point in history revisiting this question in an interesting way. The M1 money supply, of course, the statistic created and observed by the Fed, is generally a measurement of what the supply of dollars is in the system. There's an M1 money supply, there's an M2 money supply. And if you think about what dollars are, we're no longer on the gold standard, right? You can't take a $20 bill to the Atlanta Fed and exchange it for $20 in gold. We simply have a fiat currency, not exchangeable for specie. So when you think about that, and you think about the M1 money supply, which is simply the amount of money in the system, You look at the slide that's on the screen. On October 13th, 2008, around the date of the Lehman bankruptcy, we had roughly $1.4 trillion floating in the system. On April 28, 2014, we have roughly double that. That's after QE1, QE2, and QE3. So we have dollars untethered to currency. We have a doubling of the M1 money supply during the Great Recession. And I think you can start to think about the challenges our Federal Reserve has in managing our current dollars. I think, again, this opens up opportunities for emerging payment systems as well as virtual currencies. I want to hold up today's, or a page from today's Wall Street Journal to evidence the challenge that our Federal Reserve is going to have with the currency that we currently have. The top column, or the top article is, inflation picks up, stirring talk on Fed policy. Inflation picks up, the counter is moving interest rates higher, easing back or pulling out QE1, QE2, QE3. Next article, worries over global economic growth climb. What do you do if you have worries about global economic growth? You lower interest rates and you have QE4, right? You push money into the system. So when you think about the U.S. dollar, you think about it not being specie-oriented, that is just simply, in a very real sense, a confidence game associated with a piece of paper. You look at the M1 money supply and you look at the challenges that our own Federal Reserve is going to have over the next 5 to 10 years as we recover from the Great Recession. Again, I think you can see as panelists, or as the Commission can see, the task force can see, there are opportunities here for emerging payment systems and virtual currencies. And moving forward to modern payment systems overview, which is a bit of a transition from the larger strategic thoughts in my opening slides. Payment systems are simply a means by which money moves from one side to another. A payment system ultimately has three components. It has consumers on one side, it has merchants on another, and a means by which to settle those transactions. In the United States, currently, there are 6 core payment systems: cash, the checking system, credit card and charge card systems, the debit card system, automated clearinghouse, and the wire transfer system. Those 6 payment systems are utilized for the following 6 types of payments: point of sale, remote commerce, bill payment, person-to-person payments, business-to-business payments, and income payments like payroll credits, or the distribution of ACH credits for payroll payments. So again, if you think about transitioning from larger thoughts about our currency and historically how it has ebbed and flowed and the opportunity we currently have for new payment products to a modern payment systems overview, you see we have 6 existing legacy payment systems and we have 6 types of payments that are usually made. Those payment systems above, the 6, are legacy payment systems. They're what exist currently in the United States. And in many respects, those based on technologies developed in the 50s, 60s, and 70s, although they are, of course, innovating over time. But by and large, those are the legacy payment systems that we utilize. And I think there's an opportunity where technologists would say there's an opportunity because of the legacy payment systems and of our current currency situation in the United States for emerging payment products and virtual currencies. To go to the next slide, but for cash, the final 5 payment systems that were on the slide before operate in this manner. I would colloquially refer to this as either a circle of trust or a wagon wheel. And what I mean by that is for the 5 other payment systems, legacy payment systems, but for cash, we tend to have banks on the periphery that operate as the touch points for the customers and the merchants, and then you have some sort of central clearing mechanism. So if you talk about the check clearing system in the United States, you would put the Federal Reserve in the middle and all of the banks at the periphery. If you talk about the card associations like Visa and MasterCard, you would put them at the middle and you put their bank members or bank FI clients on the periphery. Again, I think a wagon wheel analogy is very helpful. And then you have the merchants and customers outside of that. Again, that's how the legacy payment systems currently work other than cash in the United States. The 4-party card network, This is an example of that transaction. You have issuing banks to cardholders, acquiring banks to merchants. You have the card associations in the middle, and you've got data flowing up at the initial part of the transaction. You've got cash flowing back to the merchant. Again, you're having the settlement system in the middle and the banks on the periphery. In this slide, which is pulled from the Federal Reserve Payment Study, the important points here is that non-cash payments continue to increase and the use of checks have fallen dramatically, and that trend line will continue. With shared attributes of successful payment systems, I'll leave this for the task force, but these are the 7 that were highlighted in a book titled The Payment System in a Market Economy: Price Stability, Thoughtful Design with respect to the nation's monetary regime, Technical Efficiency, Design with access to credit in mind, Legal Framework, Official Oversight and Supervision, Central Bank serving as a vital settlement authority. I would add principally the first point, which is trust. Every settlement system has to have a high degree of trust, and I think that trust oftentimes comes from not only credit and liquidity assurances, but from regulation of both the settlement system and the end participants. And I think that's where, of course, state banking departments and federal banking agencies play a remarkably important role. I'll spend just a second on this slide, and that is, I know that we think that so much of what we do in financial services is settled, that the U.S. dollar is settled, but I will take everyone back to 1999, and that is the beginning of the euro. The euro didn't exist in 1998. It became one of the world's currencies in 1999. And I would also point out special drawing rights, which are issued by the IMF, which help the world's central banks settle balance of payments issues. There are examples currently about novel payment mechanisms or novel currencies being utilized, which are being utilized on a global basis that, quite frankly, didn't exist very long ago. I'm going to leave with this slide, Commissioner, and that is, so much of our challenge in the United States and in the world from a payments perspective is tied to this slide. While payments are global, inherently sovereign currencies are local and regulation is inherently local. So what we have as we think about payment systems generally is an interoperability problem. We as a world, from a payments perspective, operate as islands. If I want to do a transaction with Europe, right, I've got to go from dollars to euros. If I want to do it with Great Britain, it's dollars to pounds. And we have legacy payment systems which are inherently tied within the country, each country. Mark Andreessen of Netscape fame and Andreessen Horowitz fame has a saying that he oftentimes employs: software eats blank, technology eats blank. You can see what's happened to the newspaper industry, you can see what's happened to the music industry, what's currently happening to the television industry, and if you think about fiat currencies and you think about legacy payment systems, I think you can see the opportunity for emerging payment systems and virtual currencies, because I think technology is going to focus, or the technologists are going to, and entrepreneurs are going to focus on what is otherwise legacy payment systems and fiat currencies in a way that's going to lead a lot of innovation going forward. So I think, from my perspective as outside counsel to many very talented clients in this industry, going forward, this is our challenge. We're going to have to solve the island problem. And there are a lot of companies, a lot of private equity firms, and a lot of venture capital firms that are very much focused on solving this problem, which I think then ties to the regulation and how you guys are going to have to innovate both at the state level and the federal level in a way that probably is inherently challenging but will be remarkably rewarding. So with that, I'll turn it over to Jane.
Thank you, Mr. Danu. Ms. Larimer.
Thank you. Thank you, Commissioner Cotney, and thank you to all the commissioners here today and to CSBS for having me. I'm Jane Larimer. I'm EVP of ACH Network Administration at NACHA. And today I want to cover 3 areas briefly. One is a background briefly of NACHA, who NACHA is. I know a lot of folks probably haven't heard of us in the ACH network. Talk about the ACH roadmap for future innovation, and talk about briefly the tension between increased regulation and the tension to innovate at the same time on financial institutions and the pressures that that causes. And I guess I'll forward this slide at this point. NACHA is a nonprofit association. We are the governing body of the ACH network. We are responsible for the rules, risk, system of fines, network development, new applications on the ACH network. The NACHA operating rules are the operating rules that are agreed to by the ACH operators, and then the ACH operators, by contract, push those rules down to every financial institution in the country that uses the ACH network. So the NACHA operating rules creates certainty between all the financial institutions in the country when they use the ACH network. We like to think, when you think of the ACH network, we're a little bit different than some of the other electronic payments networks. So say the card networks, they run both the switch, they switch physically the transactions, and they write the rules. At NACHA, we write the rules and we administer it, and we work in partnership with the ACH operators. That would be the Retail Payments Office of the Atlanta Fed and the clearinghouse, it's the EPN, the Electronic Payments Network. They physically switch the transactions. NACHA does not switch any transactions. We are the logical network, they are the physical network. So I wanted to talk a little bit about what the ACH network does. I think we are the electronic payment system, and now we're the legacy electronic payment system. Only 40 years old, and we've become legacy. The legacy payment system, but folks aren't familiar sometimes with the ACH network and what we do. I think everybody knows the direct deposit. So that's when I had to give my elevator speech about what I do. It's, we bring you direct deposit. But the ACH network was originally built in the late 60s and 70s, Department of Defense, looking for an electronic alternatives to checks. Back in the day, and up actually until the early 2000s, checks were actually either flown to clear and settle checks, or they were driven into parking lots and literally exchanged in bags across parking lots at the New York Fed. So it's very physical. And the Department of Defense was looking for a very efficient means to pay all of their employees who are scattered all over the United States and around the world, but at least within the United States, they thought, let's have an electronic equivalent to that. So the way the ACH was built and brought up, think electronic equivalent to check, and this was pre the big card networks. So the key mainstay of the ACH was efficiency. How do we move a lot of payments extremely efficiently? And that's how it was built up. So ACH, what happens is a financial institution collects big files of payments, multiple payments from corporates under them. So direct deposit, recurring bill payment, online bill payment, trading partner agreements, so big trading partner payments, and the federal government is the #1 user of the ACH network. So financial institutions gather these big files of payments. They send them overnight to the ACH operators. The ACH operators then clear and settle them. They route them to the receiving banks. They are settled the next morning. So ACH payments are settled overnight. They are not settled. I think a lot of times people think, well, 4 or 5 days. It's an overnight settlement. Now, financial institutions on both sides might hold availability for risk management purposes, but the settlement itself is overnight. The ACH network, because it's used for federal government payments, the ACH connects virtually every financial institution in the country. The big strength, one of the biggest strengths besides efficiency of the ACH network, is the fact that every financial institution has access to the ACH network. And I think ubiquity is one of the strongest, one of the key attributes we need to look at as we look at the payment systems of the future or innovating in the future, because closed loop systems can come up more quickly. You don't have to get 12,000 financial institutions to make a change, but it only has the value of those folks within the closed loop. It is the fact that to get to every financial institution, the value for any kind of user, if you have a large corporate who has employees in 50 states, they want to be able to hit financial institutions in all 50 states. So I think that's one of the things that, as we look at innovation, it has to be something that can be implemented by every financial institution in the country. And that's, I think, a huge opportunity, and it's also a challenge, having something that every financial institution needs to do. Lastly, just in terms of numbers and where we are as a retail payment system, so not the wire system, that wholesale payment system, but in 2013, the ACH network transferred a little under $39 trillion in value, 17.5 billion transactions, and that's through the ACH operators. That's more than 80 million transactions a day. So when you're looking at that, they are flowing into receiving financial institutions and posted through to their customers' accounts in a highly efficient format. This is just kind of looking at our timeline for the ACH. NACHA was founded in 1974, where regional clearinghouses decided to create a national rule scheme. so that they did not have to have bilateral agreements with regional clearinghouses. So NACHA, this is actually our 40th anniversary just this year. And we started, again, payroll and benefits, so that's direct deposit. But for folks, when you think of kind of the legacy payment systems, it's not that nothing has been evolving. There has been a lot of evolution in the ACH network since the 70s. We went from 2-day clearing to 1-day clearing of payments along that way. We have had B2B payments added on. We have ACH POS, so at the point of sale, you can use an ACH card. B2B with data. We started looking at electronic cross-border. We now have cross-border payments. The Fed RPO, Fed Global, runs I think the biggest of the ACH international transactions and clearing. Where we really saw volume starting to spike was back in the 2000s, before the advent of Check 21, when check conversion started. So that was the electronic clearing of paper, getting paper out of the system as early as possible, leading to big cost savings for not only financial institutions, but for their customers to really more efficiently run ACH payments than check, and actually to get returns a lot faster. Now we're looking at real-time messaging layered on top of the ACH, mobile payments, XML data within our formats. So there is a whole host of change. We haven't been stagnant. So what is the ACH blueprint? What's our roadmap for change? In 2012, we went out to a large swath of the industry stakeholders, including the Fed board, financial institutions, end users, and asked, what attributes would you like in the ACH network, looking out 10 years. So don't look at tomorrow, let's look out a little bit further, and where would you like to be? And so they brought up, in basically kind of large buckets, these are the attributes we would like to have. So part of those attributes, looking at the ACH formats, looking at credit payments, how do you start routing payments? So I can today mail a check to Chris, but if I wanted to send him an ACH credit payment, how do I get it to him without having his account number? How do I route it? So directory services are a very big deal. How do we create user enablement? How do we do more to solve the island problem, to Chris's point, with cross-border interoperability? How do we leverage the ACH network's ability to move vast quantities of remittance data? So 9,999 addenda can move through the ACH with one payment for big trading partners. And then how do we speed up clearing and settlement on the ACH? Because that's something that I think is important to all the stakeholders. One of the things that came clear, though, when we talked to everybody, you don't want to get all these new, cool, great things at the cost of losing the things that make the ACH. So you want to make sure that you don't lose ubiquity. Yeah, you might be able to do something faster with a small group, but you want to be able to enable everybody to do it. You want to make sure you still have value dating. So even though you want to have faster clearing and settlement, for some applications like payroll, you don't need to have anything faster. For a lot of payroll applications, if you have a stable employee base, then you might know, a week out or more than that, how you're going to pay your employees. And you don't want to lose either the certainty in the rule set or the efficiency. So if you make a ton of changes, if you make it more like another kind of payment system, you lose the efficiency of the payment system. So the thing that makes it a really good, inexpensive payment system for a lot of parties, you don't want to lose those attributes. So what we did is designed an architecture within the blueprint of how this could be done. The first piece of this is ACH clearing and settlement. Take the workhorse, take the ACH, the basic payment system, and start incrementally making clearing and settlement within that system faster. So that means not only for some products, say direct deposit, maybe you do want it faster for hourly payroll, right? Maybe you want to have an expedited bill pay service so I can pay you today, not tomorrow. So you want to do that. Also, the ACH is used to settle interbank for the card networks. So we're not only a kind of a payment product, if you think of a direct deposit or online bill pay, but settlement for the card networks often occurs on the ACH. So it is that backbone for interbank settlement of the other payment systems. So how do we make that incrementally better? Then how do we start adding this middle layer with verification, account verification services, routing directories, leveraging our ability to move remittance data. And then the ultimate picture was you add on real-time messaging, a layer onto that. We have an opt-in program that does this today, secure vault payments, but this could be in the payment system of the future. You have a real-time messaging capability so that I could pay Bob, he could get a message today that says the money is coming, 10 seconds after I've sent it. His bank could give him availability of the funds, and then it could clear and settle on the ACH 2 or 3 times a day. So that's the vision of how, if you have incrementally faster settlement on the basic payment system, on the ACH, you can support innovation into the future. And currently, our proposal that we have out, that we're working with the industry now, we're out talking to financial institutions, we're trying to find out the costs, we're trying to find out the opportunities, we're trying to find out how can we leverage this for innovation, and we're going out to stakeholders to see the value that they have. This is our same-day settlement proposal that we're looking at now, which is adding, by the end of a 3-phased implementation, incrementally building to 2 additional settlement windows a day for a total of 3 settlement windows, adding on funds availability requirements on ACH credits. So not only will a financial institution, when you send, say, a direct deposit same day, they will be required then to make that available to you quickly as an end user. So we think that these are the building blocks you need to be able to support mobile technology, real-time messaging, account validation, and all of the other innovation that we're looking at into the future. No red dot.
Thank you. Mr. Steen.
Well, thank you very much, gentlemen, and thank you for asking me. Bridge Community Bank is a small bank from East Central Iowa. Our charter was granted in 1903. Days like today, I feel like I was there at the beginning. Chris gave you the, I guess I would call it the 50,000 foot view, Jane at the 10,000, and I need you to come way down to the 5'8" level. Because I want to talk about community banks, and I am a community banker, and I think it's important to our economy, it's important to our communities, and so I'm going to be unapologetically community bank today. So payments has been my thing way too long, but it's particularly gratifying to me to see the CSBS take on this task force, because I think it's critical to the community bank. We have to maintain this connection to our customer, and that transaction account is the holy grail. So I've been involved in several organizations, so a lot of what I'm going to talk about today comes from those discussions. The lines will get blurred because I've worked with the Iowa Bankers Association Task Force. I've been on the Independent Community Bankers Task Force, and I was on the NACHA board. And so I look at this from a lot of different perspectives, but it all comes back to the same thing, that we have to have integrity in the payment system, and the community banks have to be in the game. And so what we started out doing was, can I leave your slide now?
Yes.
Okay. Am I going the wrong way?
No, you're going the right way. That's the index.
Okay. All right. So you'll see my bias at the outset. I think we have to work with what we have. We have payment rails, we have debit card, these have all been mentioned, the ACH, check, cash, etc. We've got to find a way to use them, because I don't think we have time to build a new rail or the consensus that we'd have to have fast enough to build the rail that we need. So I'll just say at the outset, I'll talk a little bit about the concept of building a new rail. Because I feel like I have to, but that's not where my heart is, okay? So what we started out doing is we decided we had to try to define the problem if we were going to try to figure out what the solution is. So we spent a lot of time on what we call the gaps. What's the compelling case for this need that we have? And we started at the Iowa Bankers Association level. We formed a task force. We had a lot of input from the Federal Reserve, a lot of support. But we spent many hours, many days, and trying to get to that. And then we said, okay, now we think we've defined the problem. Where do we go from here? And why? And I think it's obvious. The technology change is driving a lot of this. It's a free-for-all. Everybody's trying to get in the game. And it's happening faster, the rate of change. And so I'd rather not call it defensive, but I guess maybe that's what it is. We have to stay in the game. And I've already described who it is, who at least my circle of friends are. The vision is pretty simple. I think for us to make this work, we have to create a circumstance where the we can connect the dots so that a payment can be made between two people as though they were with one bank. It was in one bank. Yeah, now, that's not easy, but that's our goal. If anybody's left off of this, and there are hundreds that are, I apologize, but I had to do this in one page. And so there's lots of players out there. A lot of them have come and gone. Some of them have a lot more traction than others. But we've got all these directories out there in existence, but they don't connect to each other. And I think that most of us, a lot of our community bank peers have person-to-person payment solutions through our vendor, but we're sort of held hostage, not intentionally on their part, but just simply because it doesn't connect to one vendor to another. And so we've got the payment models we have, the traditionals, where people are riding the rails, leveraging what they can, and we end up with hybrids. But at the end of the day, we need some rules. It needs to be inoperable. It obviously needs to be secure and private. And then we got to be able to deal with the things that go wrong. And stuff happens, stuff that we don't anticipate, and we got to be able to handle those exceptions. Again, we leverage the ICBA and the ABA and the Fed, the EFT providers. I would add that Notch has been in the discussion from the outset, and the clearinghouse is engaged. And so I think we have all the players in the industry to try to get to the right answer. We just need to come to a consensus and be able to make the investment to get to that level. Our goals is, we need this to be faster. I think everybody understands that if we don't make it faster, we're going to get left behind, and we're still trying to define faster. I don't personally believe that needs to be instant. I think it needs to be same day, or maybe even multiple times a day, but I'm not sure it needs to be instant. There are limitations on what we can do and still protect the customer, and so we're working hard at that level. And then there's always the business case issue. But I will tell you, and we were early into the Check 21 world, that was the only easy business case I've really been exposed to, and that was after I'd spent years getting ready for it. And I'm not so sure it was so affordable for others. We were early. We were a beta bank in many instances, so some of our entry-level costs were very low because vendors were looking for people like us that were willing to try things new. Instant versus reality. I think we have light years to go for a real-time payment processing. Some folks claim they're doing that. It ain't so. There's a perception of the payment being there, but it's typically happening because somebody else's float is being used. Same day or near real-time settlement, I think that's possible. We are, as a very small bank, have enabled ourselves in participating in the Fed's enhanced same-day product. We can send and we can receive same day. We just don't have very many partners on the other side of the curtain to receive and send them to us. I do think the instant messaging is important, and that goes a long way, but it doesn't move the money. And I think it's a good goal. We need to work at it. But, all of this has to be based on good funds. If we're going to get this right, it has to be a good funds model. And so we'd like to believe the instant message is true. The money's there, or at least it will be there shortly. This is just to illustrate how as we add new players, welcome or not, the chain gets longer. The process to make a payment end-to-end is much more convoluted than what it seems for most of our customers. They have no idea what's really going on. Jane touched on it in her presentation, and just from the Notch side. But a lot of things happen. It's not free. We've somehow communicated to our customer base that this should be free. It's very expensive, and it's not free. The new rail discussion, Chris talked on this, Jane talked on this. I won't spend any time with it. They've done some neat things, but they can get a handful of people in the room and make a decision. We got something like 12,000 financial institutions, endpoints, that have to get into the game, and that's really hard. This is just sort of our options. Start with do nothing, wait and see what happens. I'll focus on the one that rose to the top. That's my bias. That's why it rose to the top. We need a national directory. We need, or at least a directory of directories to connect all the ones that have already been built. But we got to get it right. And so my personal opinion is the Federal Reserve has to drive this, and I think that that view is shared largely by the results that we saw from the responses to their consultation paper. It was a compelling theme that the Fed needs to be the leader in this thing. And again, getting back to the basic connecting the dots, checks are we still have checks. They're not going to go away anytime soon, but we do need to keep moving the ball. Same day ACH, that's entirely easy or possible. It's not easy for everybody apparently, but it was easy for us. National directory I talked about, and we use the term the FedEx approach, where if there's value in moving money faster, so you choose how fast you want to move, and there's a price for that. So if we can leverage the PIN debit network, which actually has solved a lot of this for us, and it works. It's not free, but it works. And because we do want beneficiary choice in this payment flow, we want first they need the right to deny the receipt. It's not likely they will, but they need that right. And then where it goes, they should have some voice in that, obviously. And then the near real-time payments platform is the ultimate goal. This is just, again, one banker's view. The line gets blurred, but we need to leverage what we got, and so I believe we've defined the problem. We need to set a timeline. The Fed's 10 years is a little longer than we want, but the reality is we're 2 years into that 10 years. So we need to, and then the hard part, the really hard part, to get our community bankers to buy into this. Thank you.
Thank you very much, Mr. Steen. I'm going to go right into questions here. I'm going to start with our host, Secretary Flores.
Mr. Chairman, thank you very much. First of all, I'd like to begin by commending you for your leadership in this committee and the work that you've done on the federal level as well in raising the significance of this topic. I would also like to thank the Conference of State Bank Supervisors for choosing the great city of Chicago for selecting this place as the city to host the first field hearing on this topic. And also thank you to all of the panelists. This question would be directed to Ms. Larimar and also perhaps to Mr. Steen. A question of costs. Obviously, we're talking about a very large system, very large network, a network that's been around for a very long time. And as we look at the need for modernization, that would obviously not only include efficiency but also security in the face of all of the cyber threats that we face. What kind of costs are we talking about? I mean, I think it's fair to say that it's going to be a lot of money, but have you tried to quantify those costs? And I'd like for you to also perhaps expound on what that means for the consumer and whether or not the consumer will have to bear some of those costs, and how will we know that the consumer is getting a fair shake for paying the extra costs associated with the system that they would want to see serve their needs and demand.
Hit all of those. With costs, we are actually right now quantifying the costs. So
You could just pull the microphone right close to you there. Thank you.
We are fielding a survey now, trying to delve into the cost, because it's difficult, even one-on-one with financial institutions, to say this is the prospective cost, because they're trying to scope out what it's going to be. One of the things when you look at this, there's a couple different buckets of costs. The first cost would be the operator or the switch cost to support this. So, how do you create the infrastructure or upgrade the infrastructure to support it? And generally speaking, the more that the operators or the switch bears, the fewer the costs that may move out to all the financial institutions in the country. So that's one piece of it. The second one is in the United States, as opposed to the other geographies, most of the other geographies that have gone to a faster payments. With 12,000 financial institutions, we are highly fragmented. So the costs are going to be greater here. And within that highly fragmented environment, you have FIs of all sizes. So what it takes one of the largest, the 10 FIs in the country to make changes versus a lot of the smaller financial institutions are vastly different. Also, we have payment processors. So you have big core processors who will bear the cost, which will be ultimately paid by their customers, so to do upgrades for their financial institutions below them. So there are these buckets of costs. We're going out now to try to find out, what are those costs, how much will the processors change, and then what will the cost be day to day for financial institutions. And one of the things that we've seen as we've looked at this is that the part that's really the harder part for financial institutions is the posting. It is the making the funds available in a real time or in a faster manner to their customers. And that's the part that actually gives the value to the customers. But the financial institutions, most of them have core processing systems that are 20, 30, 40 years old because they cannot fail. They're the workhorses for the financial institution. And financial institutions often are loath to change them because what if the system fails? And we've seen in other geographies some of the big financial institutions who have upgraded their core platforms and then they failed. There have been system failures. So I think that that's one of the things that financial institutions look at is we cannot have a failure. Safety and soundness and certainty of payment are the most important things. Then we have regulatory pressures, and then on top of that, regulatory compliance, and then on top of that, we want to make things faster and innovate. So coming together to bring up all those buckets of cost is something not just in the process of trying to get our arms around now. We're hoping by late summer we'll have that. I think to consumers, I think it's to be determined whether the costs will at some point for a faster payment might be borne by a consumer, the FedEx model that Bob was talking about. The fact that maybe to get my payment to somebody tomorrow or the next day, that would be free, but maybe to get it in 2 hours from now, there might be a cost associated with that. I think that that's still to be determined in a competitive marketplace. And I don't think that I can say whether that would happen. I do think that innovation, though, is expensive, and it has to be borne, and you have to give properly aligned incentives for folks to want to try to innovate.
I guess my response to that would be that typically when you're trying to move the ball forward, if you want to push back, the first question you ask is, what's the business case, or how do you pay for this? And it's a legitimate question, but and it's very difficult for community banks because we're almost totally dependent on our vendors. And because of what's driven the vendor business is that just compliance issues have created a circumstance where it's very hard to be a vendor and provide all the compliance tools that a bank would need. So now we're down to a handful of big vendors, and they're frankly they're still cobbling things up together to make these things work. They're buying this and they're buying this and they're trying to interface it together. Sometimes it works, sometimes it doesn't work very well, but it's all very expensive to the community bank. So typically a community bank will stand back and wait and see what their vendor delivers, and then you try to figure out a way to either absorb the cost or possibly even generate some revenue. That's pretty hard to do. On the security side, that's just the premise of everything we do. Guarding our customer data and protect, their privacy is paramount. In the community banking world, they know who we are. We sit next to them in their kids' school events. We know them. We have to take care of their privacy. And sometimes, it slips through the cracks, and we pay the price for it. But it's usually pretty minimal.
Thank you. Commissioner Cooper from Texas.
First of all, I've read the material you presented with interest. was about to say I enjoyed reading it, but interest is probably the more relevant term here. And y'all have made comments about this, the question I'm about to ask, and it falls under the why category, Mr. Steen, that you mentioned earlier. So first, to some degree, Britain has been able to make virtual payments now, or excuse me, instant payments now for supposedly for 6 years. So, and Mrs. Larimore, you talked about improving the timing on it. But then in 2012, in the NACHA meeting, there was an attempt to go to same-day settlement, and that didn't pass. It appears that you're talking about trying to improve it, and I guess Mr. Steen also said the same thing, to maybe not instant, but at least same-day settlement. But then you mentioned, Mrs. Larimer, that the banks, I believe the term you used, the bank could give the customer the availability of funds when they received it. So the could kind of bothered me to a degree. So the why question is, it appears that there has been at least some systems that do provide a quicker settlement, and it appears that we're trying to get there, but my question is why aren't we there yet?
A couple things. So in the UK, the faster payment system was a result of the financial institutions coming together under the threat of regulation or threat of a mandate, because their payment system, the BACS system, which is the ACH in Britain, had a 3-day, it still does, 3-day clearing and settlement, where the ACH here is overnight. And also in the UK, again, the size of the market is significantly, exponentially smaller than the size of the market in the United States. You mentioned, and I guess one more thing, in faster payments in the UK, there's two pieces of it. One is the messaging, of course, which sends the message that I want to pay Chris. The financial institution gives availability to Chris, but settlement only occurs in faster payments 3 times a day. And that is something that we're looking at with the ACH, is moving to a 3-time-a-day clearing and settlement to support innovation into the future. To the question of why in 2012 the same-day proposal didn't pass, I think it was a combination of a few things. I think first there was the work that had been done to cost it out, or that for some players that there were significant costs, and for the industry overall. But the thought was there wasn't enough value being given to all players with it. So that proposal only added 1 settlement window a day, not 2 that we're looking at now. That proposal for West Coast banks did not give a lot of value, because if you're looking at a 3 p.m. or a 4 p.m. settlement time Eastern time, it means that originators on the West Coast, 3 hours below that, needed to get files in by 11 a.m. or noon. And so that didn't provide a lot of value. So there wasn't, we called it a middle-of-the-road approach. We tried to take the kind of the least intrusive approach. And what we saw is, that there's still costs associated with that, but there isn't enough value for folks to want to try to use it. It didn't work perfectly well for same-day payday payroll. It didn't work particularly well for expedited bill payments. So what we're trying to do now is add 2 windows, try to give more availability, or more value, to the West Coast, so that the whole, over the whole United States, there's more value in there. And what we're hoping to do is then find that there's enough value to outweigh the costs that are going to be imposed by looking at a same-day service.
I would generally agree with that. There was a lot of competing forces. You had a lot of, most community banks, for example, are net receivers. And as a receiver, the easy question is, what's in it for me? Why would I want to pay that item earlier? I would argue, and I do argue with my peers, that that's the wrong answer. We need to move this along, but because those same banks, typically in a community bank world, and we are one of them, if somebody walks in and deposits a check we, for all practical purposes, give them immediate credit. We don't get availability for that item. With Check 21, it's much faster than it used to be, but now we get credit. We would hope to get credit, assuming the check's good, by midnight. And so there was just a lot of different competing forces. The clock, Eastern time, was a big issue. You get out to the West Coast, why, it's a whole different set of circumstances. But I was very involved in promoting it, doing what I could to promote it, and I'm glad that the Fed has moved to their enhanced same-day product. Don't have a lot of participation in it yet, but I think as the vendors, the community bank vendors, who have been largely supportive of the concept, at least in the response to the ballot question, I think we'll make some progress.
Commissioner Cooper, I just offer a few quick thoughts. I think one of the themes that's coming out of this panel is that at the end of the day, payments as currently constructed is a very difficult, logistically intensive business. I think for those of us that were involved in the remittance transfer rule promulgated by the CFPB, I think there was a lot of education of all the parties about how hard it is to actually move and settle funds internationally. And I think what that leads to, if you stay with me for a moment on the difficult, logistically intensive business as currently constructed thought, that leads to two conflicting ideas going forward. One is this increasing interoperability and efficiency question on the existing system. And that's where the questions have focused so far. How do we take our existing settlement system and make it more efficient, and how do we increase the interoperability? Another way to go about solving this problem, which goes to what Bob characterized as my 50,000-foot presentation, rightfully so, is disintermediation. The technologists are generally moving toward disintermediation. The non-bank financial services providers, the technology providers, are trying to leapfrog our current existing settlement system, which may or may not be a thoughtful way to go about it. But it is, as we as an industry, financial services, outside counsel, NACHA, Visa, the state banking departments, federal banking agencies, moving our existing system forward and innovating on technologies that have certainly innovated but are generally 30 and 40 years older, and a fragmented financial system creates challenges. We can continue to focus on our existing system, and people will, and in every sense, I think the card associations and NACHA and our banking system are going to be around for many, many years. Or there is an opportunity for technologists and non-bank financial service providers to innovate in a way that they don't have to grapple with the fragmented nature and the inefficiencies, and can move this forward too. So, and quite frankly, probably both will happen.
Commissioner Gonzalez from Tennessee.
Well, thank you, Mr. Chairman, and thanks to the panelists for being here. We certainly are grateful to you for the information that you're providing us. And I've got a question for the entire panel. I think it's a question that a number of people around the country have on their minds. The current payment system has certain controls built in for security and fraud mitigation. So how should we think about security, fraud mitigation within the context of modernization aimed at speed? In other words, how do we ensure appropriate coordination between speed and security? I'll start with Mr. Daniel.
I think there is an inherent tension between increasing efficiencies, frictionless transactions, and security, fraud mitigation, and I would add AML and sanctions compliance. And with the clients with whom we work, there's always this discussion about how do I have frictionless payments, how do I have frictionless transactions, and balance the security interests, the fraud mitigation, AML, and sanctions obligations. I don't have, Commissioner, a great answer for you here other than people focus on this every day, and I think there will ultimately be compromises in all processes so that proper attention is paid to all. The failure by a financial services operator to pay attention to security or fraud mitigation or AML or OFAC screening is dramatic. And so you have to, as a financial service provider, balance the two. I will tell you, everyone gives thought to this, and they certainly invest funds in it, but it is a challenge.
I think that was an excellent point about the tension, because I wholeheartedly agree that it's there. I think from the ACH network perspective and the other electronic payment systems, safety and soundness, consumer protection, risk mitigation, and trying to minimize fraud through the payment system are all the things that the financial institutions, the operators, and the users of the payment systems, of the legacy payment systems, are invested in with huge costs to be able to put that into effect. So there are regulatory burdens also, but there is reputation risk. There are wanting to do the right thing for their customers. So there are huge costs that are embedded into the system. And then with some of the newer with payment methods, alternative payment methods, technologies, what you see is, I think in a lot of ways, businesses or payments being moved into a space without a lot of that, the trappings, without the costs. And so it seems very, it's seductive in a way, because you look at that and you think, well, you don't have all the, there may be no Regulation E protection for consumers. If your computer goes down and your virtual currency is there, you've lost your money. Or so there may be a lot limited AML or OFAC screening. There's not a safety and soundness issue when you look at how small virtual currency is right now compared to the existing big payment systems. So I think when we look at that, you have to look at why people are wanting to use them and why they are seductive or why they are attractive to people. It's because they don't have all of the costs, the compliance costs, the risk cost, safety and soundness issues that the existing payment systems have. So the more we burden our existing payment systems, the more attractive these other things are for folks to want to use, because they're not burdened in the same way. But within the legacy payment systems, we're still grappling with these issues. I mean, today you have, even on the check side with remotely created checks, say, there's not centralized risk monitoring of those. You don't know if there's large-scale returns. We know that fraud tends to go in the path of least resistance. So the more controls you may put on the ACH, fraud will move off into either existing payment systems or into the new exciting things that are coming in the future. So I think that we have to look at the entire landscape and see if incentives are appropriately aligned, if the regulations are appropriately aligned, and find out why people might want to be creating new things because there are costs embedded in the old.
Well, like you would expect, I don't think it's that complicated. Somebody has allowed the bad guy to get into the payment network, and it's just following that back. If I have a customer or merchant that initiates bad payments, fraudulent payments, I'm going to be responsible for that, and I'm easy to find. And that's all we need to do. I mentioned it early in my presentation that integrity is the key to this. We have to be careful with who we give a routing number over to. It's not for lease, it's not for sale. And when we continue to just say, okay, if you can give me 10 cents or 5 cents or 2 cents for every transaction, go for it. Well, that's what's getting us in trouble, and that's true on the debit side, on the card side, and on the check side, and on the ACH side. And so it's just a matter of responsibility. We have to hold people accountable. If you allow them into the payment system and they're a bad player, there's going to be a price to pay.
Thank you. We have time for one more question from the task force. Commissioner Hagler from Georgia.
Thank you, Chairman, and thank you to the panel for joining us today. This has been very helpful. In Georgia, we've been developing a merchant acquirer limited purpose bank charter with the goal of allow merchant acquirers to have direct access into the payment card networks. Whether it's that scenario or any other where a technology company has allowed direct access into the payment systems, what would be your hierarchy of the risk that are introduced with that model? and what would be the major mitigants that you would seek to address that? And I'd throw it out to the panel in general.
So, Commissioner Hager, I'll take you guys back to one of the slides that was in my presentation and sort of ridiculously simple analogy, which is the wagon wheel or the circle of trust, right, where you've got the settlement entity in the middle and you've got the banks on the periphery. Settlement systems, payment systems only work because of trust. Let's go back to the Lehman Brothers bankruptcy in October of 2008. What happened? You had a number of financial institutions, investment banks, large commercial banks that were loaning to each other on an overnight basis, and it was a settlement network or a payment system of sort. And all of a sudden, because of the Lehman bankruptcy and the inability to assign value to certain assets on their balance sheets, they didn't trust one another. They were unable to look across the payment system, or in this case, the overnight settlement system, and determine that they trust their partners in settlement. And it froze. Hence, you had the lender of last resort, the Federal Reserve, step in, do its job, and provide liquidity to a frozen market. So when you ask about the introduction of technology companies into that wheel of a wagon wheel or the circle of trust, you guys, as state banking departments and our federal banking agency counterparts, have to think about that. And actually, quite frankly, so do the payment systems. The one thing that will take down large payment systems very quickly is that loss of trust. And it can come about in a number of different ways. It could be a liquidity problem. It could be a solvency problem. It could be a regulatory problem. It could be a reputational risk problem. So that's a long-winded answer to your question, but when you think about prioritization and the risk of allowing non-bank financial institutions into the payment systems, I think what the regulators need to think about and the existing payment systems need to think about is that safety and soundness, trust issue that won't pose a risk to the existing payment system.
I have nothing to add to it.
I'm probably the wrong guy to ask. I think it's a very worrisome path to be taken. Integrity is critical, and I think Chris explained it much better than I could.
Okay, thank you. We actually do have some more time than I thought. So I'd like to ask Commissioner Leary.
Again, thank you to the panel members for coming and being with us. I'd like to explore a little bit deeper on that fraud loss side. I know from the customer's experience, from the bank's experience, they often stand behind that fraud loss, whether it be in the wire transfer or whatever. Can you elaborate more on what financial institutions are to protect consumers in that wire transfer environment?
Can't speak to the wire transfer.
Well, we're probably not a good example because our wire transfer volume is relatively limited, so we guard it closely. It takes we know our customers, so even if we get a call for a wire instruction and we recognize a voice, we still do a callback. We have two people involved in the actual transaction. We use Fedline Advantage to do those wires, and our domestic wires, so it's a very cautious process. It's well documented. We know who we're dealing with. We know the funds are available, and so we're probably not the high volume. Our customers can originate a wire on our cash management product, but it's as though they told us in person because we still do everything we would have done had they done that.
I think fraud mitigation is very difficult, and it's in many senses an IT arms race, right? And I think that we as a country and a financial services industry within the U.S., it's going to take a cooperative effort between federal law enforcement, state law enforcement, the Federal Reserve, Treasury, the financial institutions themselves, because I don't think any one financial institution, and you can take a top 5 bank or you could take a bottom 100 bank, I just don't think they have the funds or necessarily the ability to coordinate on a global basis to fight fraud in that manner. I think it's going to take either legislative or law enforcement or otherwise, and they certainly exist. I don't mean to imply that they don't, but it's a challenging issue in many respects related to IT.
Thank you. My colleague from the state of Washington. A question? No, I'm fine. Okay, thank you. Commissioner Breakspear, do you have any questions? So I'll ask a question of each of you. So are there any state or federal legal impediments or barriers to getting where you want to go, or where the public wants to go in modernizing the payment system?
Yes. Yes, there are.
So if the answer is yes, then specifically what legal or regulatory challenges should we be thinking about?
Well, a lot of things have gone through my mind as Chris made his presentation. So on the virtual currency, as a small bank, the Treasury prints money, and then it's almost illegal to use it, right? The cash. We're reporting. We become policemen on reporting large currency transactions, and then $10,000 is the number that's sort of got locked in years ago. And so if a customer that we know comes in and deposits more than $10,000 or withdraws more than transactions, sets off a whole series of internal reporting issues, and we go into a state of paranoia of whether we've checked off every single check and verified everything for somebody we've known for 30 years. So that's an impediment, because we know that we're competing in an uneven world. And then ironically, my state now is promoting the payment of taxes and fees through a non-bank player. And it's really remarkable, because the money goes into a pooled account. If the state puts $1 in my bank, the pledging requirement kicks in. So it's extraordinary. And so, yeah, there's a lot of things at play that put us into a hopeless situation to stay competitive. And recently, the remittance rules on international transactions have really essentially taken us out of the game. So our customers are going to Walmart and Western Union, and it's unfortunate, because we can provide that service much more cost effective to the consumer, but it's essentially eliminated our role.
I think it's just a cognizance of the impact of regulation. I think there's a few things. One is players out there, end users, also want, to Chris's point, they want friction-free, they want ease, they want convenience, they want low cost. Oftentimes, the reason why you have to add friction or convenience is the safety and soundness issue, and it's regulatory compliance. So there is an end-user impact when you have layers of regulation upon it. I think also there's the price and impact of regulation. So today, financial institutions, and it's just, I would say both state and federal, so it's the layering. Right now, their IT queues are backed up for compliance changes. So the last thing they can get in, generally speaking, are innovation or just nice to haves, because they can't get into their IT queues. They're still implementing Dodd-Frank. The remittances rule is part of Dodd-Frank. The regulatory burdens right now on financial institutions mean that innovation becomes the thing that comes below regulatory updates. And I think when you're looking at the future, there is, Chris had said, this tension between, now we have regulatory pressures on both sides. One is to add a lot of additional consumer protection, fraud protection, regulatory compliance burdens with Dodd-Frank, versus the feeling that we need to be moving faster and doing, the Federal Reserve public paper on payment system improvement. So you're getting caught between two sides saying we need to do better and faster, but you need to be doing these other 100 things too. So I think it's just a recognition at the federal and state level of the impacts of regulation and what are the most important things to have, and how do we get our arms around all of that and make rational decisions about where we need the payment system to go, and the fact that you do have other players out there who are saying, we can act without all that burden. We can create something new without the burdens you guys have.
So many of our clients are in Northern California, and of course they're entrepreneurs, and entrepreneurs generally view legislation and regulation as wholly unnecessary, right? But with that being said, I think...
We take the opposite.
And quite frankly, I do too. I share your view. So with that being said, I think the best things, Commissioner, that the state banking departments could do is provide certainty here. And the virtual currency area is a great example. I will say providing certainty here is challenging, and I'll finish with this comment. We've talked about the remittance transfer rule at various points, and the education that many parties had in the remittance transfer rule is instructive here. And ultimately, we have a rule which doesn't necessarily reflect the reality of payment settlement. And as Bob said, has, in my view, unfairly taken community banks out of the game, because the rule was drafted in a way that didn't properly incorporate how difficult payments is. So, Commissioner, I think that you have a tough task, and all of you on the task force have a tough task in the sense that certainty is what industry needs, but it requires a high degree of knowledge, which isn't always easy to acquire.
Mr. Syracuse from New York.
There's obviously a lot of history to ACH and our legacy payment systems. Are there any best practices or lessons learned that could inform emerging payment systems going forward, both from a sort of practical point of view and a regulatory point of view?
I think a few things. Ubiquity is necessary or desirable. I think you want to have multilateral scaling. You need to have rule sets or business rules that are multilateral in scaling, right? So you don't want to have a bunch of bilateral agreements. You need to have certainty in the payments. And talking about Chris's circle of trust, you want to make sure that that everybody trusts each other, that they know that if one player fails, that there can either be the settlement can be recalled, or that you won't have systemic failure because of the failure of one participant. And I think the fact that consumer protections are part of our mindset, and so you should have consistency in the application of consumer protection so that there's not regulatory arbitrage. So it's not a rational decision for one player to use another payment system because that way they don't have to comply with something else. You want to have a rational consumer protection overlayment so that everybody knows the same terms in which they're playing. At least a few.
I think that was a great answer.
Yeah, the reality is, and I don't think it's all bad, that checks and ACH and debit rails work under different rules. And I think as we try to make these payments faster and give the beneficiary choice out there, I think we're pretty good. As a small bank, I can handle all three of those payments. I can work with all three of those channels, and I think I can give my customer a menu choice. How fast do you want this to happen? And there's going to be some kind of price differential because that's the only way we can make it work.
Well, I want to thank each of you for your comments and your discussion here this morning. We are going to take a brief break to transition to our second panel. We're going to begin promptly at 10:30. Thank you.